apart the stock market and put it back together so that it makes sense for you. I'm Forbes Markets editor John Dobis. Like the Beastie Boys in their 1992 album Check Your Head, we're going to go into some assumptions today that might not be quite right and could be costing you money. You know, there's wrong assumptions out there that need to be corrected. Albert Einstein, of course, wasn't quite satisfied with the Newtonian idea of physics, so he came up with his own ideas of relativity. Christopher Columbus wasn't convinced that the world was flat, and his idea that the world was round, that he could sail across an ocean and get to India, kind of changed the way of navigation in all of human history. But what we're talking about here is a more immediate concern, something that's been going on for the past year or so. We're talking about the rise of home building stocks. Toll Brothers today, the luxury home builder out of Pennsylvania, reported sales that were just through the roof, up 41%. Net income was up 46%. $1.71 billion to $1.84 billion out of 3,000 to 3,200 new homes this year. That's the new forecast for Toll Brothers. That's up from 2,600 to 11 homes just a couple months ago. So Toll Brothers is really kicking it. You can see the stock is more than kicking it here, doubling, more than doubling off of the bottom last October. Stock now peaking out near 33 bucks per share. Toll Brothers is doing pretty well because they sell homes to people who have good credit, who make a lot of money, weren't as impacted by the recession and the job losses that have happened in the last 3 to 4 years. Meritage Homes out of Scottsdale, Arizona, another upscale builder. That stock has hit new highs as well, near $38 per share. Again, Meritage serves a higher end clientele. Stock more than doubled, up about 120% just since October of last year, hot like an Arizona saguaro. Pulte Home. Pulte is doing all right. Pulte Group is the name of the company. Stock is up from $15 to $38 also, doing pretty well in shares of Pulte. If you want to play the rally in ETFs, you can do that as well. There's the ITB that tracks, that's the Dow Jones U.S. Home Construction Index, ITB, and the XHB. Both of those up about 100% in the last year. What's driving the great news in housing is the dwindling supply of inventories. The red line here, those blue lines are recessions. This goes back to 1963. These are new homes. The most recent recession is the blue shaded area over there. You can see that the months of inventory peaked above 12 months, and now we're at about 6.2 months of inventory. So there's fewer homes to choose from. That means if people want them at low rates, about 3.5% now for a 30-year mortgage, they're buying them, and there's not as many left. The National Association of Realtors, as far as existing homes go, people have already lived in them. Sales are doing pretty well, up 2.3% from June. That's the July numbers, to an annualized rate of 4.47 million units. About 5 million would put us back into what we call a regular housing market. That's up 10.4% from July, and the average price of an existing home, $187,300. That is up 9.4% from 1 year ago. So the volume of sales and the price of the houses sold are both going up. You can't really dispute those facts. Housing is looking pretty darn bullish. Here's existing home inventories, kind of the same situation you saw over there with new homes, down from 12 months of supply down to just above 6. And that's the change in inventory. Inventory has just been decreasing. Nobody's been building houses since 2007 because nobody was buying them. Ben Bernanke and his crew over at the Federal Open Market Committee may be stoking things for home buyers as well. Minutes from the Fed's last meeting a month ago came out on Wednesday, showing that a lot of members are in favor of more immediate monetary action to help keep this recovery going. Fears over a slowdown in China, recessionary conditions in a lot of Europe, and that kind of talk dominated the last Fed meeting. Bernanke in 1 week goes out to Jackson Hole, Wyoming, where he likes to talk about monetary policy among his central bank friends. And he, 2 years ago, of course, announced QE2. Will he announce a third round of quantitative easing? We don't know for sure, but the minutes from the last Fed meeting make it look increasingly likely. Fed meets again September 12th, and the helicopter just might be on the launch pad again, dropping some more dollars. Gold and the dollar, they certainly sniff a little bit of QE, or at least some more inflation in the system. Gold back up above, well, this is the GLD, which tracks gold, up above 160. That's the 200-day moving average. So that's kind of the demarcation between bullish and bearish markets. Gold going back into a bull market. The dollar falling to its 200-day average. This is the UUP, an ETF that tracks the dollar. Buck falling to its 200-day average. Gold miners, you've seen a lot of awful things on television about The mining strike at a platinum mine in South Africa, where almost 36 people were killed there, just underscores how difficult it is to get these minerals that are deep under the earth out of the ground. Gold miners, though, who get the gold out, you can see here the chart looking pretty bullish because they are making a product that is getting more valuable, gold. The S&P 500 index is just a story of bulls on parade. Good news from Bernanke and such, taking out the April highs at near 142 on the SPY. Another assumption that you might want to check your head about here is that things are bad in Europe. We've got Angela Merkel, the most powerful woman in the world, according to Forbes, on the new list of power women. She is doing things with Mario Draghi. He is the president of the ECB. Germany is kind of reluctant to go along with the big grand bailout plans, buying government bonds and that kind of stuff, but coming around slowly because maybe they realize that's the only solution that will work long term in Europe to get their fiscal house in order. But Merkel helping make things better in Europe, so Europe is not such a bad place anymore. Check out these stock markets. You've got Germany on the top here and France, both up about 20% in just the past 2 months. These are the center of the storm. Spain and Italy, also nice gains, 20% plus in the past month and a half. This means you should buy maybe some European stocks. Here's some not household names, but big companies. France Telecom pays you an 11.8% dividend yield. AstraZeneca, 3.8% yield, big drug company out of Switzerland, I'm sorry. Also a Swiss company here, ST Microelectronics. They're the biggest makers of chipsets that go into car radio receivers for terrestrial and satellite radio. ST Microelectronics, the Swiss company, 5.8% yield. Final head-checking theme we want to talk about here is that social media stocks are the wave of the future. Well, we saw that they were a great way for insiders to cash out and make tons while the little guy gets shafted. Facebook, Groupon, Zynga, all down sharply from their offering prices. Maybe they'll reach a value at some point in the future where they will be good buys, but with declining revenues and bloated valuations, it doesn't look that way. How about something a little more pedestrian? How about something that's making good money and trades at a cheap multiple? 13 times forward earnings. I'm talking about Apple. Apple tagging a fresh high today, $668 per share. Apple is off to the races. Of course, there's a lot of talk about the iPhone 5, maybe a mini iPad coming out September 12th. So Tim Cook, let's see what he's cooking up. And Google, about the same valuation as Apple, about 12.9 times forward earnings. Companies growing at about 45% a year. Google's chart tearing it up, $679. This was a stock that was $570 just about 2.5 months ago. So Google, Apple, and some other income opportunities await you.